Hey guys, Ben here and welcome to Motivation to Invest. Today we're joined by a very special guest. We've got Tim Bixby, who is the CFO or Chief Financial Officer at Lemonade, the Insurtech company which is disrupting a $6 trillion industry. Now the company had the strongest IPO of any US company on the New York Stock Exchange in 2020 and now trades at a market cap of approximately $2 billion. So in this video, we're going to discuss with Tim what makes Lemonade so special and potentially if it could be a great investment. So with that being said, let's dive in. So over to you, Tim. Just to kick things off and level set for everybody, why don't you give us an overview of Lemonade, what it does, and the vision for the company?
Happy to, and great to be here, Ben. Thanks so much. Lemonade has a couple of things that are pretty interesting. So as the name suggests, we're something a little bit different. The different part is we set out to become the world's most loved insurance company. Insurance is a sector that has a couple of things that are unique. One, it's enormous, as you mentioned, a multi-trillion-dollar industry, depending on how you count it. But it's not something that users or customers have too many happy thoughts about. Love is not a word that comes to mind when customers think about their insurance company. It's usually something a little more negative and sometimes expletive because of experiences they've had that haven't been fantastic. Our view was, let's take the most modern technology, the available tech stacks, and let's take the user experience that we've all learned to know and love through the Ubers and the Amazons and the Apples and the Netflix of the world and apply that to insurance. And we didn't say how, we said, why not? And so here we are 7 years later. We have about 1.7 million customers, primarily in the US. And I don't know if all 1.7 million love us, but a pretty good proportion think pretty happy thoughts about Lemonade.
Yeah.
So we bring unique technology, we provide consumer insurance, so all the different flavors of consumer insurance, pet, life, home, renter, and now car. And we're growing pretty rapidly and we're doing some great things.
Yeah, I've just to touch on what you said about the incumbent insurance industry. So I've actually got a quote here. Insurance companies are accustomed to making money off friction, like making claims processes unnecessarily difficult and coverage that's less than transparent. So historically, insurance companies make the contracts very difficult to understand, the process very long, very laborious, and I understand you guys are changing that. I actually read somewhere, is it you can get a quote in 60 seconds or 90 seconds, I believe?
Get a policy.
A policy, full policy in 90 seconds.
And that our customers can get, not just, and quotes are nice, but quotes are not coverage. We want our customers to get fully covered by whatever policy type they're looking for in a matter of minutes. 90 seconds is pretty fast, but it can literally be done almost 100% of the time in just a matter of minutes. And we do a couple of other things that we found are interesting is speed can create delight. And so we can actually pay out claims. You mentioned the claims process can be pretty painful. About 40% of our claims are paid out in real time with no human interaction in a matter of seconds. So there's different ways that we can create customer delight, and speed is definitely one of them.
So I wanted to dive a bit deeper into that technology. So was that technology all developed in-house, or do you know, was some of that developed from other sources or through acquisitions, or was it all developed purely? And is any of that technology proprietary in terms of the artificial intelligence, the algorithm?
100% proprietary. We built everything from scratch. One of our real assets is this system we built. It's a single integrated system built within just the last few years by a team that's on board working with us today. One of our co-founders is actually the first leader of that team that built that first product. And that's very rare in insurance, to have a single system that does every cycle, every bit of the insurance cycle from start to finish, as opposed to systems cobbled together over years, in some cases over decades.
So I understand you guys, you started off with renters insurance and then you've expanded into these different products, as you alluded to. What was the reasoning behind that? Was that for cross-selling opportunities, or was that to expand your TAM? What was the reasoning behind suddenly sort of jumping into all these different categories?
The way we entered the market was a key choice we made. So the vision was always provide a full portfolio of products, satisfy consumers across all their insurance needs. Other companies have really focused on one coverage type. And that's an okay strategy, but we chose to provide everything. But you're right, we did enter with a renter's product. The renter's market was unloved by most insurance incumbents because it was difficult to make money because of the low premium value.
Yeah.
A renter can get a policy fully covered from Lemonade and pay as little as $60 a year.
Wow.
The average is about $160 per year. It's really tough for a large incumbent to make money because their cost structure is pretty significant in most cases, and it's hard for them to price at a level that makes it competitive. We were able to come in and price in many cases 60 or 70% less than incumbents, not because we were underpricing or taking a loss, but because our cost structure is significantly less.
Okay, that makes a lot of sense. The niche you entered with the renters market, but now you're entering the car insurance market. It's a lot more competitive. So what are your thoughts on that?
Enter the more competitive sectors, the larger sectors. Homeowners, for example, is about 10 times the size of the market of renters. Life insurance is about 2 times the size of home. Car insurance is about 3 times the size of home. So these are, as you kind of move up the chain, they're dramatically larger markets, and they're more complex, and they're a little bit more competitive. And so what we brought to the homeowners market was 1 million customers. And our ability to upsell and cross-sell is now dramatically greater than it was when we started. And we also have what we call graduates. We have 1 million renters, and every day, a few of those renters decide to buy a house. Those customers, it's not a 10% upsell. If they buy a house, it can be a 500% upsell or 1,000% upsell, 10 times the premium.
So that's a growing with your customer strategy.
That's right.
How many states are you in the US now at the moment?
At least one product, but each of the products is at a different number of states. Car, for example, is only in about 10 states because that's our newest product. And over time, we expect it will be in all 50 states with all of our products, but that's a work in process.
What's the barrier to expanding across the different states?
Further regulations. So in the US, each state is its own country, essentially. So it's state by state. Each has their own sort of rules and requirements. So we're working at expanding across all of them.
Yeah, I understand you're also in Germany, Netherlands, France. Are you guys going to move into the UK market? Because a lot of our viewers are in the UK. I'm personally in the UK. What are the barriers to that potential entry?
UK, as you know, is now sort of part of Europe, but no longer part of Europe.
Yeah.
The insurance regulations have kind of mimicked that. There's some grandfathering that goes on there. But the UK has always been an important potential territory for us. Those who are kind of looking around in the market will see that we've made some moves towards being prepared to launch in the UK at some point. So it's very interesting for us. No formal announcements yet, though.
Yeah, I can imagine the product doing very well in terms of the marketing, the brand, the style, the give back, the social cause side of the business. I feel all that will resonate really well with the UK audience because it's very similar in a lot of ways to the US market. Do you want to elaborate a bit on that policy where you guys give back?
Sure. So, a big part of us working to become the world's most loved insurance company is to kind of support efforts and causes that are close to the hearts of our customers. And in fact, from the day the business was started, we built into our business strategy, our structure, something called the charitable give back. So each of our customers, as they join Lemonade, as they get their first policy, chooses one of the charitable organizations that we vetted. And we have a long list of really broad range of charities. And it's not so much that we're just donating to charity. It's a donation that's directly tied to the loss ratio experience of our customers. And so the way it works is if a set of customers, let's say 1,000 customers all choose the European Red Cross, for example, as their charity, if the loss experience of that group of customers at the end of the year is better than average, then the charitable give back will be greater. Yeah. And so it's directly tied to the business results of our customers. And what we find is that our customers are not so much thinking about Lemonade when they're filing a claim. They're thinking about the charity that they're supporting. And so what we hope is happening, what we expect is happening is that the likelihood that a customer might inflate a claim, which has been long a scourge of the insurance industry, might be a little bit less. if you think that you're potentially reducing the amount of a charitable donation to a cause you really care about, as opposed to taking money away from the big insurance company. And so that's something that's at the core of our strategy, and it's called the charitable give back. We once a year we send out checks to a large number of organizations. We just did it this past July, and it's a great annual effort of the company.
No, it makes a lot of sense in terms of aligning the incentives of the insurance company, the policy, and then also the customer and what they care about. So then, like you said, they're less likely to make up false claims, which is obviously a major problem in the insurance industry. I also understand you guys have got this lifetime value model, which you use for predicting customers in terms of churn. Do you want to elaborate a bit on that? And I understand you've got different versions of this model.
And this is something we did highlight. We announced our quarterly earnings for the second quarter recently, and we talked in a little more detail than we have in the past about the way we approach new customer acquisition and how we think about the lifetime value of our customers. So in the direct-to-consumer world, thinking about lifetime value is not unique. Every company thinks about it and works to evaluate it, estimate it, forecast it. What's unique about Lemonade is the depth, two things really, the depth of the data that we collect about our customers, because 100% of our customers are digitally enabled. They're buying through the website or through the app. That's not common in the insurance industry. There's many customers, the vast majority come through an agent structure. We collect about 1,800 data points for every new customer. So it's really rich, deep data. And so the more data you have about a customer and the more data you collect around claims, the better you're able to leverage that data in thinking about lifetime value. So we talked about, LTV 6 versus LTV 5. It's the newest version. It's not a super clever numbering system. But basically, each iteration leverages more granular data and enables us to really hone in on which products are working well versus others, which channels are the most lucrative for acquiring new customers, maybe which counties within each state should we spend more versus spending less. All of this data really enables us to really effectively target which customers we want to attract and acquire, and which customers we want to maybe not attract so much because they're not a healthy, long-term profitable customer.
Yeah, focus on your most valuable customers, which are going to have the largest or longest lifetime value. So do you guys have a team of data scientists that develop that, or in-house?
Relative to insurance companies, again, it's the core of the business. Something like 25% of our entire headcount of the entire business is product, technology, and data-related efforts. So at Lemonade, it's not an IT group that's off somewhere else, building things to some spec. It's the core of the business. And it's all about the customer experience really being built by that team. And then the data analytics folks are the ones who can really leverage this deep data that we collect.
Makes a lot of sense. So speaking of data, the recent acquisition of Metromile, I'm assuming, was that a data play? And obviously it expands your opportunity into the auto industry, but was that also for data reasons in terms of the data that Metromile has collected on all the vehicles?
It wasn't the only driver, but it was a key driver. What we found when we came upon Metromile, which has been around for several years with one core product, a car insurance, auto insurance product, they had a couple of innovations. They have a pay-per-mile model, which enables customers to pay a fixed fee plus an incremental fee based on how much they drive. Telematics is a phrase or a term you may have heard in the auto insurance business, where you're collecting a great deal of information about the behavior of the customer. Auto insurance historically has been very demographics driven. What's your age, your gender, your claims history, maybe your credit score, things like that. We now, through the acquisition of Metromile, have this deep data, hundreds of millions of miles of driving behavior that we can now leverage and again filter and apply our algorithms to that data that help us figure out what's the LTV, what's the lifetime value of each customer. And it's much more in depth, it's much more thoughtful than the age or the gender of a customer.
So I saw in terms of that acquisition, $145 million worth of stock you acquired it for. The company had $155 million in cash, 110 million car insurance premiums. It seemed like a very good deal. So I just wondered, how did you guys get such a good deal on that acquisition? Or was Metromile looking for a larger company to take them over?
Timing is everything. And so we began speaking with Metromile about a year ago. Valuations look very different in the general tech market and the Insurtech market and across the entire market for that matter. And we put together a structure that put a ratio of the value of our stock to the value that we acquired. And when the business is, or when the market value is corrected, that ratio was still intact. And so I think it was a smart way to structure a deal when the timing of the close is uncertain. It took 11 months or 10 months to close the deal for regulatory reasons. One of the challenges that Metromile and some of the other Insurtech companies have had is customer acquisition is very difficult. And so they were able to raise money, launch a great product, but they were struggling a little bit with growth. If you don't grow, it's hard to right size, it's hard to get to scale, it's hard to get your loss ratios to the right place. And those are all the key things for younger insurance companies. Because we've been really adept at customer acquisition, acquiring new customers efficiently. That was something we were able to bring together with Metromile, leverage their data. And you're right, the price was at what we think was a very a more than fair price for the assets that we acquired.
Yeah, amazing price. How many states is Metromile in at the moment? And will that obviously impact the amount of states you guys are in?
We were in 3 states, that's now gone to 10.
Okay.
They've got applications in others. And so that's one of the assets we can really leverage all of their regulatory work in process. Cash, they brought data. They brought about 100,000 customers. They brought about more than $100 million in in-force premium, plus this regulatory benefit.
So are you familiar with Root? So they're very similar to Metromile. They offer very similar services. They're not doing too great, but they've recently got a nice partnership with Carvana, obviously the online used car retailer. I just wondered, is Lemonade thinking about any larger partnerships or exploring different partnerships, or is that not part of the strategy currently?
So yes, we're open to that sort of a structure where if we can acquire customers more efficiently through or with a partner, that's very interesting to us. The bar is pretty high because our efficiency is pretty, we're pretty good at direct customer acquisition. And we also find that with partners, it can restrict some of your efforts to really bring the customer experience to the customer, which is a real strength for us. So it's interesting. We haven't done that many, but there are some that we think over time we'll probably be able to bring to market.
If we think about competition for a moment, obviously there's a few players in the space. You guys seem to be doing the best so far, in my opinion. And in terms of the analysis I've wrote on the company and for Yahoo Finance and Seeking Alpha, I consider Lemonade to be the best Insurtech out there on the market, publicly traded at the moment. In terms of the large incumbents, in terms of their revenue, the sheer size and scale of them, is there any reason in your mind why we don't see those large incumbents trying to acquire some of these smaller Insurtech companies? Like you've got Hippo on the house insurance, you've got Root on the car insurance. What are your thoughts on why we aren't seeing that from the larger incumbents?
Been efforts over the years to kind of replicate some of the successes that we've seen, Lemonade and other of the newer, younger, more innovative, tech-driven insurance companies. But it's been very difficult for a large incumbent to do well. Almost by definition, they have to cannibalize their own business. Or selling direct to customers, well, you've got a large agent force over here at your business. And so the better you do direct to consumer, the more it cannibalizes your existing business. They've got infrastructures and executive teams that are really motivated to do something that's very different than what Lemonade and some of these other companies are doing. And so building has been difficult for them. Buying, which I think is your question, your specific question is, I'm not sure that the innovation that an independent insurance company can bring thrives within a big company. And so it's something that, over time it could happen, but it's not happening because it's not an obvious thing. One of our greatest assets is our ability to move very quickly, adapt to market changes, change our code, change our product literally 6 or 10 or 20 times in a day. These are not things that are common capabilities at large incumbent insurers. And so I think the conflict is very great in what's made Lemonade successful versus what made large incumbents very successful. So it's a real challenge. I think, Lemonade's vision is to be a very large independent insurance company. I would agree with you. We don't look around and see anybody who's in a better position than Lemonade to become that large, digitally enabled, global insurance company.
From somebody I've worked with large organizations in the past, and I feel a lot of it's the cultural side of the organization, and obviously the systems. A lot of them they're transforming to the cloud. They're going through this digital transformation to improve a lot of their systems, but then it's still the cultural side of things in terms of a lot of these companies, they don't like experimenting, they don't like trying new things, launching new products, and they just tend to sort of stick with what they know, which obviously they're doing extremely well doing that. Like you alluded to earlier, people's habits are changing. What people want and demand as a consumer is changing in terms of people want this exceptional Amazon-style service where they could purchase a product online and get fast delivery. Similar with insurance, they want that quick, fast, personalized service. So Lemonade, I think they definitely got a fantastic opportunity. Talking about yourself personally, your average day or your average week, what do you find is the most challenging? What do you enjoy the most? What do you enjoy the least?
I think what I enjoy the most is the challenge of what we're doing. The metaphor I like to use is it kind of feels like climbing Mount Everest at times. It's a really hard thing to do. You know where the top is, you know how many feet it is to get there, you know what the equipment is you need. Every year, there are people who don't make it to the top of Mount Everest. It's a really hard thing to accomplish. And so what we've set out to do is a couple things. One is to create an unbelievable, unparalleled customer experience. And we've really done that. We've accomplished what we haven't accomplished yet, size and scale and the profitability that comes with that. The difficult part, but it's a knowable part. That map is drawn. Those steps are known, and we're working our way up those steps. The hard part, the consumer experience, the very high net promoter score, the speed of our product, the speed of claims, that's the hard part, and we've accomplished it. And so I feel like this trade-off, it's kind of like, I know we're going to get to the top of Everest because we got enough oxygen, but it's going to take a certain number of steps to get there. And for us, that's really just continuing to acquire customers, cross-selling those customers, and step by step, we're seeing the shift from unprofitable towards profitability. All of our customers can be profitable, but our business is not yet profitable. One of the things we said this past quarter was we see Q3 as being our quarter of peak losses, the highest loss in the history of the company. So we can see that we're turning that corner where we're kind of making those steps towards profitability. That's what's most interesting to me is
seeing the journey play out and being part of obviously creating that journey. I think, you guys have got the right team, and the TAM is just so huge. It just seems like somebody should be disrupting this big insurance market. And obviously you guys seem like the best people to do it. From all the other people I've studied and analyzed. In terms of the metrics that you use to analyze the company, you obviously use in-force premium, your number of customers, premium per customer, dollar retention rates, loss ratio. In terms of in-force premium, because I've seen on a few different Insurtech companies, they use slightly different metrics to measure theirs. So they might use like written premium or earned premium. How does in-force premium differ from these other metrics, more traditional metrics, I'll say?
We have all the traditional metrics, and we share those metrics, and we don't hide those. But we felt part of the benefit of us going public as one of the first and earliest Insurtech companies was we got to write part of the book, part of the playbook. And so we thought very long and hard about which metrics we wanted to use. Keeping it simple for our customers and keeping it simple for investors as well is important. In-force premium is something anyone can understand, whether they're a tech investor, a growth investor, an insurance expert. It's a common language. It's how many customers do you have and how much do they pay you each year? And that's it. Multiply the two together. And so it's very common in the tech sector. It's like annual recurring revenue or a similar metric. And so it's just a very simple way to look across product lines and get a bit of a forward-looking view, because we're growing so quickly, of where the business is headed, not where it was a quarter ago or a year ago. And that's why we like that metric.
Okay, yeah, that makes a lot of sense. So In terms of your loss ratio, can you talk us through the trends you're seeing with your loss ratio?
Ratio, obviously a key metric in insurance business. It's very simply the losses you pay, the claims you pay out, how much money, and then also how much does it cost to manage those claims? Something called loss adjustment expense, which is basically the administrative costs. And our loss ratios have varied over the years, over the past 2 or 3 years, between the 60% range to the 90% range. And that's as expected. When we were a one-product company with primarily renters, we saw our loss ratio go from 300% when we started the business to 200 to 100, down into the 60s, because the business became more mature. We learned more, we had more data, we were able to manage our loss ratio into a very effective range. As we launched newer products, it's common to have a higher loss ratio in newer products. So our homeowners loss ratio is a bit higher, cars a bit higher, but within each cohort, we're seeing improving loss ratios. Long-term, our target is a loss ratio of 75% or better, 75% or lower. And so that's a strong performance in the industry. We're not there yet, but we have line of sight because of our data scientists who can kind of predict future loss ratios. We're starting to see the newer cohorts tracking toward that improved loss ratio.
Okay, that makes a lot of sense. So what about your operating expenses? What are the trends you're seeing with that in terms of improvement? You said about peak losses Q3.
There. So we've grown very rapidly. There are 2 key ways we invest money. One is acquiring customers, so our growth spend. And it's important to note that we expense all of the cost of acquiring a customer upfront on day one. That's very different than an incumbent insurer who might be paying out a commission. And then 2, people, a payroll to hire a product team and an engineering team and a data team and all the customer-facing folks. That's also a significant investment. We saw over the last 6 months, our headcount didn't change. And it's been growing historically at 50 or 60 or 100% year on year because the business was growing rapidly. We've now hit the point where we're starting to see some real leverage in both of those cost lines.
Okay, that makes a lot of sense. And I read through your financials. I saw with your sales and marketing spend, you guys saying that you're going to cut back on that moving forward. What's the reasoning behind that in terms, is that the up and coming forecasted recession, or what are your thoughts there?
Yeah, so we're really focused on the capital we have, the cost of capital, and making sure that we can control our own destiny. So our cost of capital today is almost 10 times what it was a year ago when valuations for public companies were much higher. We were smart enough and with a little bit of luck around timing, able to raise more than $1 billion about a year and a half ago through an IPO and a secondary offering. So we're very well capitalized. We don't want to be in a position where we're forced to raise more capital to grow the business at a high cost of capital. Today is still a relatively high cost of capital. So dialing back on our growth spend, moderating our growth rate enables us to say, we can get to cash flow break even or profitability on the capital we have raised to date. So that's our statement. Now, if markets change, we've got more than enough places to profitably invest more money, to invest more capital. We'll take advantage of that if the market conditions change, if the cost of capital comes down. But if it doesn't, we're not forced to raise more capital.
Really, that's what you guys alluded to in your earnings report with regards to this mile per hour strategy changing to more of a miles per gallon focus strategy. So you're focused on more of a marathon, less of a sprint,
Exactly.
Moving forward.
Exactly.
So is this
in the same direction with the same goal, but expending a bit less gas or capital to get there.
Okay. So is this more of a process which you guys a strategy, shall I say, that you guys expect to do for maybe the next 1 to 2 years before you then decide to go more aggressive again?
I think I wouldn't put a time frame on it. I think we've been very good at adapting quickly to market changes. So as we worked through the pandemic, for example, we were able to dial down growth rate quickly and then dial it back up as soon as we saw that it really wasn't affecting us in any negative way. Similarly, this year we were able to dial down that growth rate. We're able to react pretty quickly. And so whether it's a year or two or shorter or longer, our ability to pivot, I think, quickly is one of our real proven strengths. It's harder for a large incumbent to make quick moves. Lemonade can do so without really putting the business model or the growth trajectory at too much risk.
Okay, that makes a lot of sense. So here's more of a fun question. Why is the company called Lemonade?
So the easy answer and the true answer is, how do we bring to someone on what can be the worst day of their year, filing an insurance claim? How do we bring them a little joy and a little pleasure and a little love? We're helping customers make lemonade out of lemons.
Okay, yeah, that makes sense. In my post, I wrote the title as "Freshly Squeezed Insurance" by Lemonade.
Very nice.
So it's great. But Tim, it's been fantastic having you on. I'm sure everybody's learned a lot about the company and a little bit about yourself, and also knowing a bit more detail about your vision for the company and where you plan to take it. So I think Lemonade's got a fantastic market opportunity. I think you guys are the best team to actually execute on that opportunity. I think the product's fantastic. I think the experience is amazing. And I think really it should be a walk in the park, even though it will be a challenge. But I feel compared to the competitors, I think you guys are definitely in the best position. So been fantastic having you on. That's everything from me.
Thanks so much, Ben. It was a pleasure.
Cheers. Thank you.